Better System Trader, episode 22.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 22, and I'm your host, Andrew Swanscott. Do you have a trading project that needs a programmer specializing in quantitative research? Do you have an idea for a trading strategy but don't know how to test it properly? Well, Alvarez Quant Trading offers trading research, consulting, and coding services for all requirements. They also offer an Amy Broker programming course for those who want to learn how to code and test their own strategies. For more information, head to the show notes, bettersystemtrader.com/22. This week's guest is Robert Bubalovski. He's a managing director and head trader at TradeView Investments, a privately held proprietary trading firm located here in Melbourne, Australia. Since 1996, Rob has been actively involved in the financial markets, and in 2012 he decided to set up his own proprietary trading firm to concentrate on his own trading strategies. His team of prop traders specialise in trading equities, futures, options, FX and money markets across multiple exchanges around the globe and around the clock. In this week's episode, we discuss prop trading, the challenges and lessons from beginner trader to starting an investment firm, and what it takes to be a successful trader. We also discuss arbitrage and pairs trading strategies, statistical rather than indicator-based trading, and the importance of simplicity. We also have an announcement about the book giveaway at the end of the episode, so look out for that. Anyway, let's get to it. I hope you enjoy this week's chat with Robert Bubalovski. Hi Rob, thanks for joining us today. Could you please start by providing some background on how you got into trading?
Sure. Thanks, Andrew. Thanks for having me. Look, basically, I started back in 1996. I had $1,500 and I wanted to trade the markets. So I went to a full-service stockbroker and, he happily charged me $100 per trade and we started trading shares. Which was pretty good for him, but look, it was actually quite good for me as well because he was able to make me some money, which was quite good. And that's pretty much the first start. And to be honest, look, I wasn't born a trader. I really did not know what I was doing, but the broker. I'm pretty happy about this because the broker actually, he used to call me up, and I was a $1,500 account back in 1996. I mean, that's not a big account. And he used to call me up and he used to talk to me about the markets, and he really actually explained why we were buying that stock. And I know it was his job as well, but look, he really started to help me out to understand the markets more. And he also sent me out a lot of information about the markets. So that was a really, really good start for me. And I basically listened to everything he was saying, which sort of, helped me move forward.
So was that was your introduction to trading, but when did you really start trading on your own?
On my own, I probably started back in about 2000. I opened up a ComSec account like probably everyone else and started trading penny stocks. And look, things grew from there. I worked in the market making space for a while. And then about 4 years ago, I decided to basically leave and do it all by myself.
Okay, so let's just have a quick discussion about where you are now, because I understand you have your own prop trading firm, investment company. So can you tell us a little bit about that?
Sure. Basically, TradeView is a self-funded proprietary trading firm. So I'm the owner and founder. And effectively, what we do is I'm looking for traders to sit and trade with me and for me. that's predominantly what TradeView is. It's just a prop firm that looking to trade all asset classes.
Okay, well, can you give us an indication of the styles of strategies and the markets that you trade?
Absolutely. Look, TradeView's we're more of a systematic trading firm, where, as probably most of your listeners would know, is sets of certain criteria that needs to be met before any trades are made. The criteria that we've sort of moved into now is more of a mathematical approach rather than a technical indicator approach. And we basically build models, test them, analyze them, and we trade them. We run 12 models at the moment, and we run them across various markets, and most of them are fully automated, but some are also semi-automated.
Right, okay. So there's quite a few systems you're trading there. Where do you get the ideas for these systems from?
Oh, look, Andrew, they come out of trial and error. Originally when I first sort of started doing my own stuff back in 2000, bought a charting package and started playing around with that. So I'd probably say that the first or the core strategy, that we have a core strategy called FICM, and that probably started back in around the 2000 mark, but what it was back then is completely different to what it is now. But I think the core base of the strategy remains. So what it does is it looks for a momentum shift in the markets. So that's predominantly how the core system's structured. And then all the other systems that have sort of sprung off from that, we do scalping, we do mean reversion systems. So we've just basically built upon what we've known or how we sort of look at the markets, and just add other strategies that either complement it or do something slightly different, so that we're not always going in the same direction.
You mentioned there that the core strategies have changed slightly over the years. So how do you know when a strategy may need to be adjusted or tweaked?
Look, it's a really good question, Andrew. And mainly what happens is with models is strategies, they start to break down in a way where the patterns that you're looking for are no longer there. Okay? Mm. So the patterns start to change, and of course you start to see more losses reoccurring, and that's sort of the early signs. And then the secondary signs is, of course, when the drawdowns start to blow out and they start to change dramatically to what they were in testing. So that's sort of some of the primary things that we look at when a system starts to not behave itself. Let's put it that way. I call it not behaving.
So obviously then all these systems that you're trading have been tested. What type of system performance or metrics are you looking for when you're building those systems?
One of the key factors that I look for is minimum drawdowns. I really don't like systems that produce high drawdowns because in testing, when let's hypothetically say a 1% drawdown can easily blow out to a 3% drawdown in live trading. So if you start playing with systems that have a 20% drawdown in testing, then it can easily blow out to 30-40% in live trading. So that's why we try and look at that as one of the key characteristics of how we implement the system. Also, the structure of the system is important. So as I said, we've got a core strategy, so we've got a core base, and that core base is important to us because, let me put it this way, when it's running hot, it's running really, really well. And we like to stick to that. So as long as the other systems complement it, and we're really happy with that.
Yeah. Okay, and when you're building these strategies or testing them, how do you make sure that what you're creating isn't over-optimized and that it's a robust strategy?
Look, there's a couple of things that we do. I'd probably say from a testing point of view that we don't really reveal. I do apologise that, Andrew.
That's okay.
But our quant developer has worked for some of the bigger hedge funds here in Australia, and we've kept a lot of that quiet internally, if you want to call it. But the one thing I could probably say is that from a testing perspective, when we backtest, we try to backtest once, get a rough idea of where the optimal levels are, and then forward test, of course, only once. So that's sort of a very basic or generic way of doing it. But then when we start analysing it as well, when we start analysing the testing, we look for certain criteria that doesn't look like it's optimized, right?
Yeah.
So we try and avoid optimization as much as possible. So we want to try. How do you put this? I'm a trader I believe I'm a trader first and foremost, and then an algorithmic trader secondly. So from a trading perspective, I want to know that it can work or has a very high potential of working, and then when we build it into a system, then we try and give it little tweaks without over optimizing it. So if I had the stop loss at 25 points, for example, but the testing says that the best level for the stop loss will be 28 points, then we would consider that without over optimizing it. But if it says that the optimal level is 58 point stop loss, then that's a lot further away than what we originally expected. So they're the things that we sort of look at.
Okay, and when you say forward testing there, are you talking about live market data, or do you set aside a portion of your data set to do that?
Well, look, we actually do. Yeah, we do both. Before we trade a model live, as in like with real money, we will get a section of data. So, for example, let's say we pick March of this year. So we'll do a forward test on March and only on one set of data, and so we only do that once. Yeah, we'll pick specific sets of data. So we'll pick it when the system's running well. We'll also pick it when the system's stagnating, and we'll also pick it when it's in a drawdown. So we'll give it, we'll try and pick 3 different styles of forward testing, so that we're not just only getting the best results.
Okay, that's an interesting way to look at it. Yeah.
Yeah, and then when we forward test on a demo, we allow it to go, but we're monitoring it, and if we see something different, we let it go, but we will then build the next model or a version of that model, and then test that separately.
Okay, all right.
Yeah.
Thanks for that. So I'd just like to move on a little bit to prop trading now.
Sure.
You've already provided some background into your prop trading business. So I was just wondering, could you give us a bit of an indication on the typical progression of a prop trader?
Yeah. Look, prop trading is actually a really, really cool job, if you want to call it. The reason why I say that is because there's pros and of course there's pros and cons, and the biggest pro for being a prop trader is you trade for yourself. You set your own hours. If you make some good money in the morning, you can go home in the afternoon. Effectively, basically, you run your own destiny. But the cons are quite simply, and without being coy about it, you trade for yourself. That's a con as well, because when you're having a tough time, you've got to get out of that. So mentally, you've got to be mentally fit. You've got to be, your strategies need to be up to scratch, and the progression from being just a normal trader to a prop trader and continuing. I think it's continuing to develop not only yourself but also your models. Right, because I'm sure your listeners would know that the markets do change. They never stand still. And, some people will call them that they're random, and look, from time to time they are random. So you need to be prepared for the next move. You need to be prepared for the next trade. That's something that a prop trader should look to do. I mean, we do that here. The progression is from my end. The progression is moving from a retail to a prop trader is exactly that. Just being prepared for the next move, if you want to call it.
So this question's probably a little bit difficult to answer because it obviously depends on the person, but how long would it usually take for a prop trader to become profitable?
It is a difficult question. That is actually a really good question. We get asked that all the time. How long will it take me to become a successful trader? If you come and sit here every single day and, continuously build models and test them and analyze them, and you're mentally fit, if you've got good models, and let's put it this way. If you think like everyone else, it might take you a lot longer because you're just going to continue to do the same thing as everyone else does, right? Or the 95% out there. But the ones that succeed pull the trigger. They keep on working on their models. They don't make excuses. They literally just keep on. They just keep on doing it. So if you do that day in and day out and just continuously moving forward, between 6 to 12 months is not an unreasonable ask. But if you excuse my upfrontness, if you fluff around and expect someone to, give you the answer every time, well, yeah, you're just like everyone else, and that's not going to work.
Yeah, sure. So what about for someone who's looking to get started in prop trading? What advice would you have for that type of person?
I was gonna crack a joke there, Andrew. I was gonna say, don't do it. Don't do it. Go back. Don't come towards the light.
Well, that's a good thing, right? Because you're acknowledging there that it's not an easy thing to do, and I imagine that there's only a small percentage of people who start actually end up making it.
Yeah. Look, we get that here as well. We get people coming through the desk, and the people that survive are a small number. I'd probably say that it is a different way of life and a different way of thinking, because to be a prop trader is actually quite good. Look, don't get me wrong. I want to stay unemployed for as long as I possibly can. I can take the kids to school in the mornings and then be ready for the Australian session afterwards. So I think the big thing about people wanting to be a prop trader is, look, if you've got that little bit extra, I'm trying to explain it as well, Andrew, so I hope the listeners understand. It's not enough just wanting to be a prop trader. You've got to want it that little bit more, okay? And that little bit more is actually quite a lot more. But it's just getting over that little hill. If I explain it from a sporting term, or I've played sport in the past, and like when you hit the wall and your legs can't run anymore, but the guy, I used to play soccer, and the guy that you're marking is running towards goal and he's got the ball in his feet. You're not just going to stand there. You've got to run. That little bit extra, that is what is needed. When you hit the wall and you think you can't get over it, you've got to keep on going.
Yeah, push through it.
Push through it. And I know it's, like a lot of people talk about that, but until you experience it, when you get over the other side, I mean, for me, look, the idea of it being tough is true, but when you get to the other side, right, it's such a relief, and it's just a really good feeling. It's like seriously good. it's I won't call it euphoria, but when you get to the other side and you've made it, you're like, wow, I've made it. And it's like, sorry, I get emotional about it. It's actually quite, I've never really talked about it much, but it's been a tough road. And to get to where I am, the way I've been able to get here, it's really, really cool. It's just really cool.
Yeah. Okay. So you said that it's a tough road. Can you share any challenges that you met along the way and the lessons that you got from those?
Money, not knowing what I was doing, thinking that what I was doing was the wrong thing. But probably the biggest one for me, being a male, is I realized early that I didn't have to always be right. Okay. And unfortunately, as males, we have this big ego problem that we think we need to be right all the time. I remember when I was younger, I was like that. But when I started trading, I started to realize very, very quickly that if I don't listen to the people that are actually doing it successfully, then with all due respect, I'm an idiot.
Mm.
And I learned very, very quickly that as soon as I found someone who knew what they were doing, I latched onto them without being a leech. Sorry, I sort of took what they were talking about and what they did. You know, I listened and I implemented what they were talking about. And you know, I wasn't. I think reflecting back, I don't think I was one of those guys that thought I knew everything, because I don't know everything. Right?
Mm.
I think at the time the markets, and from a prop trading perspective and the market's perspective, if you think you know everything, well, then you'd be the richest person in the world. So from my end, I think if you can have a little bit of humility and find people that are actually doing it successfully, you know, have a listen to what they're saying. Have a listen, at least you know, the way I see it is give them the courtesy, right? Because you know, now that I've done what I've done, I know the hard road that I took. And anyone that's, you know, successful in any career, it didn't happen overnight. And I respect it completely, because I'm sure they ate 2-minute noodles and toasted sandwiches like I did.
Yeah.
Do you know? I know it's, you know, but it's just one of those things where I have a very, very different respect for it. Let's put it that way.
Yeah. Well, that's some great advice there. Thanks, Rob. I'd just like to change topics to a presentation you recently made in Sydney on pairs trading and arbitrage. Now, it's not something we've discussed on the podcast before, so I'd like to have a quick chat to you about that. Firstly, can you explain what that is?
Oh, look, basically, arb or pairs trading is when you're looking for, or when you're trading two instruments of similar characteristics. From a stock point of view, it can be BHP and Rio. From a index point of view, it can be the Dow and the S&P. So what you would basically look for is, I mean, to give you a very simple overview of it, let's say, for example, the Dow. I should have brought up my things. I've got them here in front of me. But let's say the Dow, on an average, over, 5-year period, moves 150 points, right, per day, and the S&P moves 13 points, and it's usually a 10-to-1 scenario when you're trading these instruments, because the Dow is at 7,500 and the S&P is at 2,100. So you would look at things like that, and you would try and evaluate if the Dow had gone up by about 3% and the S&P has only gone up by 1%, then there's a bit of a 2% spread. Now, this is a simple explanation. I mean, there is a little bit more technicalities behind it, but the idea is that markets mean revert, and effectively the Dow and the S&P tend to go up in similar fashion. So if the Dow's gone up by 3% and the S&P's only gone up by 1%, you would technically sell the Dow and buy the S&P, so that they can mean revert. Either the S&P will go up to 3% and the Dow will only move up 0.5%, or the Dow will move down by 1% and the S&P will move up by 1%, and then you can make money on both sides. You know, we've done similar trades on the Dow and the ASX, for example, recently. There's there's plenty of opportunities to trade like that. And the reason why we look to trade like that is the risk factor. Okay, so the payoff may not be as great as just picking the direction on the market. Actually, that's a good thing that I didn't mention that before. But we're not really that focused on picking the direction all the time, because at the end of the day, it's all about risk management. And let's say if in a perfect world, the Dow moves up. Let's say you sell the Dow, right, and it moves up by 150 points, and the S&P, you buy it and it moves up by 13 points. So effectively, 13 times 10 is 130. So you only lose 20 points, for example. I mean, this is just in a perfect world of a exact move on both of them on their daily ranges for the past 5 years or thereabouts. So you would only lose 20 points. Now, I'd rather only lose 20 points than get the Dow position wrong and lose 150 points. Okay, so hopefully, I'm sure your listeners will understand what I'm talking about. And then, you can go into arbitrage and you can really go down to the smaller time frames, and usually some of the instruments will spike early and then the others will follow, and you could grab that price discrepancy within the first few minutes of a trade, if you want to call it that. So that's some of the things that we do here.
Okay, cool. So when you're trying to determine which pairs are suitable to trade, I mean, some are obvious, like the Dow and the S&P, but what if you're doing stocks, you're looking for similar characteristics? How would you quantify that?
Same, pretty much the same way, Andrew. BHP and Rio is an arb trade every day of the week. Most of the professional guys that I know arb that way. And the other reason why with stocks, you would also, very important with BHP and Rio, you can trade BHP and Rio during the London session.
Yep.
And you can trade it in the US with the ADRs. And if you can find stocks that trade on multiple exchanges, that is probably the best one, the ones that you should look at, because then if you get it wrong in the Australian session, you could probably pick it up in the UK session. Okay. Whereas otherwise you'll have to wait for the next day. Whereas you want to try and peg back some of those. Look, everyone talks about profits, but I talk about losses because we try very hard to manage our risk here more than anything else. And if we can do that correctly, then the profits, should come. So as long as we've got money, like the old cricket saying, if you bat and ball, if you lose your ball, you can't play cricket. Same as with trading. If you lose your money, you can't trade the next day. Yeah. So if you can keep your money for long enough, hopefully, you should be able to make some money. But that's effectively, if you don't get it right during the Australian session, you can work on what you did, what the movements were on the Australian session, and you can work on those pairs during the UK session and also the US session.
Okay, so back to your pairs example then with BHP and Rio. Obviously, they're both resource stocks.
In the correct sector, yeah.
Yeah, so can you do pairs across sectors?
Look, technically you can. I mean, pairs and arbitrage can get very complicated. We try to avoid complication when we're arbing or using pairs trades. Price discrepancies are a little bit more complicated because that involves the movement of a particular product at a certain time. But with pairs, if you want to start cross-sector analysis and all that kind of stuff, then it can be done. We don't do it because I try and keep things simple here. And what's probably made me move forward more than anything else is the simplicity of things. I try very hard, and I tell these, my guys as well, try to keep it simple. The simpler you keep it, when it starts breaking, the easier it is to decipher what it is that's breaking. Whereas if you start complicating things, I mean, look, I'm not the smartest bloke in the room, and I admit that. So I keep it very simple. if I can keep it simple and I can understand it, then I can explain it to someone else. And if they can understand it, then I think it's a good model. But if I start, making it very complicated, it will be complicated for the normal human being. I'm not a quant. I'm not a computer programmer. So, yeah, I try and keep it very simple, Andrew.
Yeah. Okay. So, if anyone wanted to get into pairs trading on arbitrage, how would you recommend that they start?
Very slowly. Very slowly. Look, if you've traded normal products before, as in like just normal stocks or indices or FX or directional, there are a couple of sites out there that do correlation matrices. That's probably the best way to sort of look at it. Maybe look at the correlation between two pairs, or look at their daily movements. So that's another thing. So typically look for stocks. If you're doing stocks, look for them within the same sector. So BHP and Rio is a good start, and that's a good one to bite your teeth on and paper trade that. So you'll see the movements of BHP and Rio, and then you can you can start structuring models around that. If you're worried about stocks, then move over to something like the S&P and the Dow. That is not as aggressive, and also it's not necessarily reliant on news announcements. With stocks, you could be caught in a news announcement scenario where the one that you've gone long just announced that the CEO was bankrolling his holiday from the company funds, and the stock goes down. So whereas with an actual stock index, it'll take a lot more to push it down than just one stock.
Yeah, sure. Okay. So you've worked with quite a few traders over the years. What are some of the common issues you see in traders that come to you?
Look, there's quite a few. The common ones I'd probably say is not understanding what they're actually doing. And what I mean by that is, as I said, I didn't understand when I first started. The main thing I think I'd probably say from that is that understanding their models, understanding what they're actually trying to do. A few people have come to us and they wanted to do a breakout trading model, whereas they didn't understand the logic, if you want to call it, of what's needed from a breakout strategy. It's not as simple as just breaking out on the fact of breaking out. Are you trying to take 50 points out of the breakout? But the setup prior to that doesn't allow for a 50-point move. Those type of things are crucial, and a lot of traders that have come to us haven't sort of got that balance right yet. So we're very particular about understanding what the model's trying to do and whether it can burst towards a 50-point profit target. So I don't know how to explain it in more detail, but I think that understanding the model and the logic behind what you're trying to do is very important.
Yeah, I agree. So if you had to boil it down to just one skill, what do you think is the most important aspect a trader needs to master to become successful?
Ooh, I didn't expect that question. You know what? I actually didn't expect that one. That's a killer. One skill.
Or maybe not a skill, an attitude or a behavior.
Wow. Sorry, mate. You actually did stump me.
Do you want me to ask another question and we'll come back to it?
No.
I mean, you've been kind of indicating all through the interview about the type of things that traders need to overcome and what they need to do to become successful. So I think you've already kind of touched on it a little bit, but.
Yeah. Look, I'd probably say from my end, from what I've done, is that little bit extra. It's not a skill. It's a state of mind. It's that little bit extra, Andrew. I can't explain it. It's pushing through the barriers because it is hard. It is hard. And if you don't toughen up yourself, the market will beat you down, because the market is a very, very big place. And it doesn't know where my stop losses are, even though it stops me out sometimes. So yep. I think that's the key. It's that little bit extra, that push through, that determination. But at the same time, it's sort of a combination of things. If you don't, if you're not on the right path from a model perspective, then you can have as much determination as you like, and you're never going to get it right.
Yeah.
So one thing, it's like, maybe it's a couple of things, I don't know. Get the models right and have the determination at the same time.
Okay, let's have a quick chat about drawdowns, because I think handling drawdowns can be one of the biggest challenges for a trader. How do you personally handle drawdowns?
You can tell now I'm a joker. Not well.
That's a common answer, I think.
Not well. Everyone says, "Oh, don't take it personally." You know what, Andrew? It's my money. I do take it personally. I take it very personally. Look, this probably. I'm probably going to reflect onto something that we haven't spoken about. Mm-hmm. With this drawdown part, and I think it goes hand in hand with another question some traders have asked me in the past about how do I increase my size and feel comfortable with it, right? Mm. And what I talk about is the consistency factor. If you can get the consistency right at let's call it $1 a point, right, at a very small size, then when your account size increases, or you put more money in, or however you do it, then you can step up to the next level, right? Whether it's $2 a point or $3 a point, because you're not doing anything different. Okay?
Yeah.
You're still doing the same thing as what you were doing with $1 per point. So there's no real change in logic. There's no change in attitude, right? The only time people get into trouble is when they increase the size too early, right? And they're not ready for it because the consistency is not there, and they've increased the size and the markets change. So I wanted to bring that in because I think that goes the same with drawdowns, right? Mm. If your consistency is there and the drawdowns start to occur, then you know at what point you need to stop them, or stop the bleed, if you want to call it, right? Because you've done the testing, you've done the analyzing, and once they start occurring and the patterns start changing, then you need to stop them. You just basically need to stop, take a step back, and push forward. But I think that comes with the consistency factor, because I hope I'm sort of explaining this correctly. If your consistency is there, then the drawdowns will be consistent, whether you're trading with a smaller size or a larger size. That's my experience, and yeah, I hope I sort of answered that.
Yeah, you did. Thank you. So you talked about detecting when the pattern's changing. If you're running so many strategies, how do you monitor the performance of all of those?
Look, some of the scalping ones, they're a little bit harder to detect because there's really no pattern, if you want to call it. It just means you're starting to lose more money. That's the general pattern of a scalping system when it's breaking down. Whereas with some of the other ones that move forward, we have, like I mentioned earlier, we look at a mathematical formula more than anything else. And when those processes stop occurring, then we know something's not right. So we've gone that little bit extra and moved away from your standard type indicators to more of a mathematical scenario. So, I mean, without going into it too much, but, one up bar, one down bar, for example. to me, that is explained in a mathematical way. And when we start seeing, let's say, for example, the pattern is supposed to be one up bar and one down bar, right? Mm. If we start seeing 3 or 4 up bars and then 2 down bars, then the pattern's changed, right? And that's sort of, one scenario. Other scenarios can be that, there's a lot more of these bullish candles or bullish bars where the markets will flush out the traders, right? Which has happened just recently, where the market will go down by 30, 40 points and then rally straight back up. Okay, stuff like that we take notice of. And then we also, that's on a daily bar, for example, but within the smaller time frames like your 1 and 5 minute, we really look at the price action to see where the real price jumps are. Yeah.
Yeah. So was there any particular reason why you prefer a mathematical rather than an indicator-based approach?
Look, leading and lagging. We try very hard to stay away from lagging indicators. The mathematical approach, the mathematical approach came from an indicator-based start, if you want to call it, because, that's all I knew at the start. But then I started to basically look further into what's actually happening, and then we started to create a more mathematical approach. And the mathematical approach is more a here and now scenario. So I'm not waiting for the moving average crossover, for example. If the bar is an up bar, I'll take the trade.
Yep. All right. Well, thanks for that, Rob. I'd just like to wrap up now with a few quick closing questions.
Sure.
The first one, what's the biggest lesson you've learned through trading?
Humility. I've had to be humble. Well, I'll be honest, I've had to be humble. I when I was a kid, I thought I knew it all, but I realised I didn't know it all.
Okay, and what's the best trading advice you've ever received?
Don't be too greedy.
Yep, that's a good one.
Don't be too greedy. And that was taught by the stockbroker that I first started with. He said to me, Rob, he goes, we need to give a little bit back to the markets. We can't be greedy, otherwise it'll take it all back. So we need to just give a little bit back. So don't be greedy.
Is that the same stockbroker who was charging you $100 transaction costs on a $1,500 account?
That's funny. Well, that was their standard going rate.
Yeah, right.
But no, that's it. Yeah. Don't be greedy.
Yeah. Okay. Do you have a favorite trading book?
I didn't know. Oh, there's quite a few of them. Pass.
Pass, okay.
Pass.
And what's the best way for listeners to get in touch with you?
Oh, look, through our website, tradeview.com.au. They can send us a message or they can call us. If we don't answer the phone, it's probably because we're busy trading. Try not to call us around the open of the markets. We're sort of busy at that time. But other than that, they can just jump on the website. Our email, general email is admin@tradeview.com.au.
Yep.
And then just send us an email or give us a call. We're happy to speak to people that actually want to, move forward in their trading.
Yeah, okay. Did you want to quickly mention what you've got available on the website?
Yeah, we can do that.
Yeah, sure.
Look, the business model that we've got is one of where, we've got a trading desk. We've got 9 seats here, and to find traders for the desk here, our filtration process is done through trader development programs. So, for example, we do a beginner program, of course, for people that don't know anything about the markets. We've structured it in a way where we want people to learn in a certain way, because a lot of people sort of will do Forex, for example, but they won't learn anything about the money markets. So I think there's a lot of things in the beginner program that talks about, why markets are structured the way they are and how they talk to each other. So I think that's also very important. We have an intermediate workshop where we teach people how to build their own models. Then we have an advanced strategies workshop where we mentor people for 12 months and give them 3 strategies. The advanced systems workshop is basically sitting here on the desk, and we help with continuously building the model so that they can improve them and make them better. We do custom coding. We do consulting. So if someone wants to talk to us about their strategy, we can sit down with them and have a chat to them about that. We do the trading desk, or the seats on the desk are usually invite only, and it's usually people that have gone through the programs, because we get to know what they're like, and also we get to see if they're building some good quality stuff. And we do one-on-one basically consulting or coaching, if you want to call it, from a trading perspective. And we also have like a little small community. It's a member portal where we have a live chat room, and we talk amongst ourselves. And yeah, that's a good way to start with us. For example, if you want to know whether we know what we're talking about.
Yep.
Oh, look, I mean, that's from our end, we think it's important that the right people, if they come to us, they do the right program.
Yep. Simply
because I don't want people just to buy a product. I want them to be part of our team, in the long run. So that's what we're looking for. We're looking for good quality traders, Andrew.
Yep. Okay, great. Well, hopefully you'll find some through this interview. So
absolutely, mate. We do hope so. We have got the feelers out there.
Yep.
A lot of the guys on the site. There's one guy, Edwin, came through the trader development programs. He's one of our systems developers and traders now. So he came to us about 1.5 years ago. There's another guy, Ali, who did our March program. He's sitting on the desk now for about a month now. So, we've had a few people come through the process, but a few people have stayed and a few have left.
Oh, great. All right. Well, thanks for sharing that with us, Rob. Is there anything else that you'd like to mention before we wrap up today?
No, look, I just want to say thank you, and I appreciate the opportunity, and that we're being recognised as a trading firm, which is what I've always wanted to do ever since a very long time ago.
Yep.
So I've been able to sort of push forward and jump through all the hoops, all over all the hurdles, and really grind to get to where I am. And I'll be honest, it's, if anyone's thinking of doing it, I think it's the best job in the world.
Fantastic. So thanks for your time today, Rob, and the chat. It's been really interesting, and I highly recommend anyone who's interested to go and check out the website tradeview.com.au. Rob, thanks for your time today. All the best.
Thanks, Andrew. Have a great
Cheers,
one.
Mate.
Bye-bye.
You too. Bye. Thanks, Rob, for spending time with us this week. Here are a couple of my favourite takeaways from the chat with Rob. I was quite interested to hear about arbitrage or pairs trading. Not having much experience with arbitrage myself, I found some of the ideas Rob provided were quite interesting and perhaps worth further investigation. Rob also talked about using statistics for trading rather than indicators because indicators are lagging. One example he gave was how being aware of an instrument's ADR, or average daily range, can be helpful when trading. Also, Rob really emphasised that traders that want to succeed need to have that little bit extra. So if you've hit the wall and you think you can't get over it, you just have to keep pushing. I also liked his quote, "If you think like everyone else, it might take you a lot longer to be successful." If you want to get more information about this episode, head over to the show notes, bettersystemtrader.com/22. We have links to additional content. Plus, as Rob mentioned, TradeView also offers a couple of trading courses they put their prop traders through. So if you're interested in learning more, check out the links on the show notes page, bettersystemtrader.com/22. And for those that entered the giveaway to win an entire year's worth of trading books, the lucky winners of the 3 main prizes and 9 lucky dip prizes have been drawn, so check your email to see if you're one of the lucky winners and keep an eye out for more giveaways in the future. We have another one or maybe even 2 small ones scheduled for September. In next week's episode, we talk to a fund manager that's using artificial intelligence and machine learning to trade. It's a really interesting chat, so make sure you catch that one. Anyway, I hope you enjoyed the chat with Rob this week. Thanks for listening to Better System Trader. I'll catch you next week.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.